Would you rather have a fat wallet or a fat bank account, or live in a house with no mortgage? I'm going to tell you in this video why your parents' investing advice is completely wrong.
Why is it that if your interest rate on your mortgage is 8% and your investing rate is 8%, that your results are going to be wildly different?
So this is Humphrey Yang. I love this guy. First time I've actually watched his stuff, but he's very concise. The thing that he's saying is that if your mortgage interest rate and your rate of return on your investments are the same at 8%, that will change things as if your interest rate on your house on your mortgage is less than your return on money, or vice versa. If you're getting a lower rate of return on your investments, let's say you have money in a high yield savings account at 4%, but your mortgage is at 8%, that's obviously going to lean more towards you paying off the mortgage in a shorter period of time, or focusing on paying that off, as opposed to the opposite if you're getting a higher rate of return through your investments in, like, let's say, a mutual fund or a stock.
We are now trying to compare the amortization of the mortgage to just the compounded growth of the investment, which by nature, we really can't compare the two. Your extra payments in the mortgage are going to reduce the principal faster, and your savings are in the form of reduced interest over time.
It's really impossible to track down exactly what's going to happen in the market in the future, right? The only thing we do know is that if you have a specific interest rate on a mortgage, that's your benchmark, right? So let's say your interest rate's 7% and the current mutual fund that you're invested in is doing 9%. Well, you're in the green by 2%, right? So if you keep your money invested, your money is going to compound instantly, and you're going to gain more money on your money by having that money invested, as opposed to paying off your mortgage in a shorter period of time. The nice thing about paying off the mortgage in a shorter period of time is you're applying more principal payments, reducing the interest, and in that sense, you're saving the interest, right, by paying it off in that shorter period of time, as opposed to investing.
In the investing scenario, you are taking your money and compounding the returns immediately, which in turn grows your end balance exponentially.
He also was using 25 years here. Obviously, if you don't have 25 years to invest, or 25 years on your mortgage, that's going to change. If you have, let's say, if you're older, let's say in your 50s or 60s, and you're looking to pay off your mortgage because you're looking to retire within a period of time, that will change this mentality as well. One of the things I've always lived by, being my age, 30, 40 years old, the whole thing is that when I think of investing, I want my money to compound. And whatever I make on that investment, whatever interest I make, is basically offsetting any interest that I'm paying, and I'm leveraging that debt correctly. Because if you just aggressively pay down your mortgage, you're just building equity in your home in hopes that the home appreciates. That typically does happen over time, but I don't know about you, I like to see money in the bank, right? Not necessarily equity in my home. So you just have to make sure that whatever you're investing in, whatever mutual fund, stock, ETF, whatever that may be, you're making at least the same or higher than your mortgage rate, and that will put you in the green.
The lower your interest rate on your mortgage, the better it probably is to invest. And number two, the longer your time horizon, the better it is probably to invest.
The lower your interest rate on your mortgage, the better it is to invest, right? And number two, the longer of the time horizon you have, meaning the longer you could invest your money and allow it to compound and grow, you're better off investing as well. So if you have a higher interest rate, and let's say the stock market, mutual funds, bond market tanks, you're most likely better changing your focus, pivoting, and paying down your mortgage a little more aggressively. Whereas if you're earning more in your portfolio and you have a higher rate of return than what you're paying in your mortgage, you're better off investing and keeping that money compounding. So at the end of the day, you see a larger figure in your bank account and not so much in equity of the home.